Are you crazy buying bonds? That's the attitude I'm getting a lot here lately. We'll talk about that today on 3 Minutes on Markets and Money. Over the last couple of months, interest rates have been rising because of fears of inflation. There's certainly a negative attitude towards owning bonds currently. And of course, investors are selling bonds to get into equities over these fears of inflation, right? We're going to have raging inflation. We're going back to the inflationary pressures of the 1970s. Well, that's not really the case. The environmental and economic dynamics are totally different than they were back in the 70s. We're no longer a manufacturing-based society that has high rates of output. We're now a debt and leveraged economy that has very low output in terms of economic growth. And economic growth is eventually this year going to return back to that 2.5% growth trend we've been in. And now with the Fed starting to hike rates and tighten monetary policy, that's going to further reduce the inflationary pressures on the economy. Bonds have absolutely been under pressure here. Back in July of last year, we were hitting all-time highs in bond prices, yields hitting some of the lowest levels that we've seen in quite some time. Since then, interest rates have been on the rise, forcing bond prices lower. This is a chart of TLT. Of course, that's a 20-year duration bond ETF. Those prices certainly have fallen here. Those prices of TLT have certainly been under pressure. But why would you want to be buying bonds? Well, bond ETFs are just like an equity, and we treat them just like equities. They get overbought and they get oversold. Back in July of 21, bonds were extremely overbought. We recommended taking some profits and reducing some risk back then. Now, bond prices once again are extremely oversold here. And again, just like equities, this is the opportunity to buy an asset price that's cheap. It's oversold on a lot of different degrees. And if the Fed does hike interest rates to slow the rate of inflation and economic growth, which is the whole purpose for hiking rates, at a time where all that liquidity hit the economy in 2020, 2021, that liquidity is now gone, which means that consumption and economic growth will slow. That suggests that we're going to see economic growth slow, inflation slow, which should push yields lower, bond prices higher. Now, has there been a point in time where we've had previous oversold conditions like we're seeing currently? If we look back at the history of TLT as a proxy for bond prices, what we find is that every time in history where bond prices have been as oversold as they are now, going back throughout the entire history of the ETF, that has been a primary buying opportunity for bonds. In other words, bond prices oversold. And again, as I said earlier, just like an equity, when bond prices get this oversold, it is generally a good time to start adding money into bonds as a risk-off hedge for a portfolio, which means equity prices get weaker, money flows from equities into bonds as a safety trade, and with the Fed hiking rates, reducing monetary policy, liquidity coming out of the system, economic growth slowing, we're going to potentially see more downside pressure on equities over the rest of this year and money flowing from risk into safety, which would be bonds. And again, this is something that we just simply have a lot of history on, telling us that when bonds get this oversold, generally it's a good idea to own some bonds in your portfolio. So am I crazy for buying bonds here? It may seem that way right now, but again, this is a monthly chart, so this takes time to play out. But later this year, I suspect that bond prices will be one of the better performing assets in your portfolio. I'm your host, Lance Roberts, for 3 Minutes of Markets and Money. A little bit crazy, of course, but we'll see you next time.